In the previous video, we discussed a typical market buy order. I think the example we used was buying 1,000 shares of Coca-Cola Company stock. So we talked about the total outlay being, I think it was $40,335, including commissions for 1,000 shares of KO stock. So what happens? You created an account at a brokerage firm and you sent the orders through the website to the brokerage firm, and the broker on the floor executed the order using the instructions you sent them. So what's going on? You had already funded your brokerage account with some money, and so they just deduct the money from the amount that you already had and transfer in the shares. I wanted to take a closer look at the mechanic behind that happening. So when the shares are finally transferred to your account, that is at the end of the negotiation and trading, they actually will be transferred at the end of what's called the settlement period. So for stock, the settlement period is 3 days. And the concept behind the settlement period is back in the olden days when they had actual physical paper stock certificates and lots of actual cash, what these traders would have to do is physically transfer the paper stock certificate. Let's make a little stock certificate here. Looks a lot like a raffle ticket, I guess. This is not what a stock certificate actually looks like, but let's say stock KO for Coke. So they would have to take 1,000 of these that belong to someone else at some point and physically deliver them to your brokerage firm, and your brokerage firm would hold on to these in filing cabinets and keep them safe. That's part of what they do. It's called custodial services. So back in the day, it would take 3 days to physically deliver these paper stock certificates, and you can imagine a world in which it might take 3 days to actually transfer $40,000 plus to the market makers and traders who traded with you. But nowadays everything is done electronically, so it's very quick, but that 3-day holdover is kept just to make sure that all the trades are done properly and that all the numbers are correct and no one's made any mistakes. So note that the previous example and the video I made before was for a buy transaction. So the mechanics and order of operations for a sell transaction are almost exactly identical. The broker approaches the market maker with a sell order and solicits bids. Remember, in this case, we're selling. That means the traders are buying, so they're submitting bids. By the way, so that you know, when we say bid, that is a buy order, and an offer or ask is the sell side. So a bid refers to the buying price, actually, and the offer or ask is the selling price. The selling and the buying price are not necessarily the same. When they are the same, that's when you have an actual transaction occur. But until that point, they may be a few cents away from each other. They may be much further away. But we'll talk about that in another video when we discuss liquidity and market making. So I'm just going to paste in the diagram I drew in a previous video of market makers, but it'll help to serve what I'm talking about now. So let's think about this transaction from the perspective of a market maker. So in that first transaction from the previous video, you, the investor, were looking to buy a stock, specifically 1,000 shares of Coca-Cola, and the market maker or market makers are creating markets for you. They receive the order from your broker and they decide at what price they are willing to sell. Unlike you, they aren't really interested in investing in this company. They're not out to buy and hold and wait for the price to go up. They don't want to take that chance. They just are in it to provide liquidity. And we can talk about why they want to do that in another video, but let's suffice to say that this is their job. So they want to get in and out of the stock as quickly as possible. So if this market maker has now sold 100 shares, KO, at $40 a share, now inventory, whatever amount of shares he started the day with, is down 100 shares. So to make up for that, the next time broker comes to the pit and asks for shares of Coca-Cola, he's going to slightly skew the price at which he's willing to buy and sell. So before, he said he was willing to sell 100 shares of Coca-Cola at $40 a share. Well, maybe now he'll say, I'll sell the next 100 shares of Coca-Cola at $40.50. And by the way, if you want, I'll buy 100 shares of KO I'll pay you I don't know, let's say $39.50. This way, it'll entice more buyers into the market. In this way, they're constantly adjusting their bid and offer prices. So this is the offer and this is the bid, as I mentioned before. Typically, you'll see both sides quoted. If a broker comes to the market and says, what do you guys think about Coca-Cola? The market makers will respond saying, I am $39.50 bid, offered at $40.50. And they might say on 1,000, meaning 1,000 shares on either side, willing to buy and sell the same amount. This is kind of a market maker lingo. You probably don't need to worry a whole lot about it, but some people may find it interesting. So they are holding too many shares of a stock. Let's say they might reduce their selling price in order to entice more people to buy. If they sold too many, they might improve their bid price to get more people to sell to them. In the end, they want to come out roughly equal. So you've probably heard the phrase buy low, sell high. Well, it definitely applies in the stock market. In fact, that's probably where it came from. In effect, a buy transaction then is a bet that the price of the stock is going to increase over time. So this is the primary reason, as you might expect, why investors buy stock. They expect that the price will go up, and when they sell, they'll make some profit. But what if you thought that the price of the stock was actually going to decrease? Remember, we said the price of Coca-Cola was trading at $40, but we bought it because we thought it was going to go up. But what happens if you think the price is going to go down? So far, we've only described a way to profit from the price going up. Well, you can actually profit from the price going down by executing what's called a short sale. So short selling is a little bit more complicated. In a nutshell, what you're doing is you're selling high first and then buying low. So you're going to sell something you don't even have and then buy it later. So we'll definitely get into the mechanics of selling short in another video very soon.